Hey everyone, this is Matt with the Fundamental Investing Institute. Thank you for tuning in. Today's video is going to be part 2 on the valuation question and how we kind of go about doing it in my experience. So this is in these SMB acquisitions. I talked about how we're defining cash flow, and we get to a real residual figure. So it's the residual cash flow available to the capital providers. Now, once we get at that base level cash flow, we're going to do two things from a valuation standpoint. One is we're going to apply a valuation multiple, so we're going to value the entire company. And the second thing we're going to do is we're going to create a market value balance sheet. And what a market value balance sheet is going to do is it's going to break down the market value of all of the assets that the company owns. And then when we take that and we take the valuation, we also get an asset that we call Goodwill. And that's the difference between the tangible assets, the value of the tangible assets, and what we're paying. So let's start by defining a multiple. A multiple is the inverse of a yield. Now, when we say yield, what we're thinking is, just for analysis purposes at this point, we're going to assume that we're going to finance the deal with all equity. We're not going to use any borrowed money. We just do this to get the ball rolling on the analysis. So if we bought a business using all equity, the 100% of those cash flows pre-tax would be available to us. So that would be our year-over-year return, or what we might call our cash-on-cash return. So let's think about, we usually want a return, a cash-on-cash return on an unlevered basis or without debt. We want that to be 20 to 25%. Now, the way that we convert this into a multiple is we just take, so in this case, 20% would be 0.2/1. We just take the inverse of that, and that would be 5. That would be a 5 times multiple. And then we can take 0.25/1, take the inverse of that, and that would be a 4 times multiple. So 5 times is kind of the maximum that I would want to pay for a lot of these businesses, assuming I'm very confident in that cash flow figure. So just to give you a scenario, if you have a business with $200,000 in cash flow, in normalized free cash flow, and I'm confident that that is the real figure, the figure that we want to use, if we're looking at a 4x to a 5x, we get a value between $800,000 and $1 million. So that's our, what we call enterprise value, because it's the value of the entire business. Now, the second thing I'm doing is we're going to do a market value balance sheet. Now, if the business is listed by a broker, most business brokers will do this. They will provide, well, certainly, anytime you look at a business, the seller has to provide a list of the assets that the company owns. Now, if it's broker listed, they've usually done some analysis to estimate the market value of those assets. Now, the balance sheet is showing those assets at historical cost minus depreciation. So what we want to do is we want to know what today's value of all those fixed assets, tangible assets are. The great thing about the internet is we can actually come up with that information pretty quickly. I can't even imagine how you had to do this 30 or 40 years ago. But now you can do an internet search and you can look at resale values for similar assets. So we have a list of the market value of all of these assets, and we have the enterprise value, the estimated enterprise value, and the difference is called Goodwill, or in this case, we're going to call it accounting Goodwill. And then what we do is we take all of these assets and we list them as a percentage of the total enterprise value. And that just sort of tells us how much of that purchase price is tied up in Goodwill versus hard assets. That's something the bank's going to want to see as well. But that's really the analysis. So at this point, we're not going really in depth. This is all kind of back of the envelope math, but it's very important. And this is the first point before we start to think about how we're going to finance this acquisition. So thank you for tuning in. We'll talk more about cash flow and financial analysis in subsequent videos. Thank you.